Welcome to a comprehensive look at the UK's upcoming tax changes for non-domiciled, or non-dom, individuals. These updates represent a monumental shift in how foreign income, gains, and inheritance are taxed in the UK, a move designed to make the system more equitable but with potentially significant implications for the wealthy international residents and investors who have long taken advantage of these unique tax benefits. For over 2 centuries, the UK has offered a distinct tax regime for non-doms, allowing foreign income and capital gains to remain untaxed if they're kept offshore. This remittance basis has made the UK an attractive destination for international residents seeking tax-efficient ways to protect their global assets. But now, starting in April 2025, the UK government is replacing the remittance basis with a residence-based tax system. This move will tax global income and assets based on residency, not domicile status, a shift aimed at leveling the playing field while maintaining competitiveness in attracting talent and investment. The stakes are high. Under the new rules, foreign income and gains will face UK tax once a person qualifies as a resident, regardless of where their permanent home is. This change affects everyone from multinational executives and entrepreneurs to those with foreign inheritance structures. The government's goal is clear: to prevent tax advantages for long-term UK residents who technically hold foreign domicile. If you're a non-dom or considering relocating to the UK, these reforms could significantly impact your financial planning. So, stay tuned as we unpack everything from capital gains adjustments to inheritance tax shifts, practical examples, and expert insights to help you navigate this new tax landscape. What does non-domiciled mean in the UK tax system? The term non-domiciled, or non-dom, in the UK refers to individuals who live in the UK but do not consider it their permanent home. Instead, their domicile, or permanent home, is legally tied to another country. For non-doms, the UK tax system has historically offered special treatment through what's known as the remittance basis. This system allows non-doms to avoid paying UK tax on income and gains earned outside the UK, provided those earnings are not transferred into the UK. A 200-year legacy, history of non-dom status. The non-dom tax system has roots that stretch back over 200 years, designed initially to attract international investors, wealthy foreign nationals, and globally mobile individuals to the UK. With its unique tax benefits, the system became a powerful tool for bolstering the economy by encouraging high-net-worth individuals and professionals to make the UK their home, even if temporarily. Over time, however, the remittance basis came under scrutiny, with critics arguing it allowed unfair tax advantages for wealthy individuals living in the UK while working to protect assets and income from foreign sources. The last significant change occurred in 2017, when the UK government implemented a 15-year limit on how long an individual could claim non-dom status while residing in the UK. This change ensured that long-term residents would eventually face the same tax obligations as UK domiciles after a set period. Still, the system allowed substantial tax breaks for new non-doms and short-term residents, which many viewed as a disparity in the tax structure. Why the changes are happening now? The 2025 reforms are part of a broader strategy to modernize the tax system, targeting perceived loopholes and aiming to ensure that all UK residents contribute fairly. The government argues that these changes are necessary to address the imbalance between long-term non-doms and fully domiciled UK residents, creating a more equal system. According to recent government reports, the new rules will eliminate the tax advantages previously enjoyed by non-doms under the remittance basis. The UK is shifting toward a system that aligns more closely with international standards, where tax liability is based primarily on residency, not domicile status. This transformation is expected to bring in additional tax revenue, estimated in the hundreds of millions annually, while also aligning the UK's tax practices with other major economies such as the United States, where global income is taxed based on residency. The upcoming changes signal a fundamental shift in how the UK approaches foreign income and wealth. For individuals who have relied on the non-dom tax regime, understanding these changes is essential to adapting their financial strategies and maintaining compliance with the new rules. The shift to a residence-based regime for foreign income and gains, FIG, starting from April 2025, the UK will replace the remittance-based tax system with a residence-based regime for foreign income and gains, FIG. This new system means that individuals will be taxed on their worldwide income if they qualify as a UK resident, regardless of whether that income is earned or brought into the UK. For many non-doms, this change is a fundamental shift that eliminates long-standing tax benefits. Under the new FIG regime, newly arrived non-doms can receive 100% tax relief on foreign income and gains for up to 4 years. However, this relief only applies if they have not been tax residents in the UK for any of the previous 10 years before their arrival. This 4-year relief period allows new UK residents to adjust their finances but is considerably shorter than the indefinite or 15-year tax benefits previously available. For individuals planning to relocate, the policy change underscores the importance of careful financial planning and timing their residency start date. Example scenario: how the new FIG rules impact new residents. Consider an international business owner moving to the UK in 2025. If they have not been a UK tax resident in the prior 10 years, they can benefit from the 4-year FIG exemption. During this period, foreign income, such as dividends from overseas investments or rental income from foreign properties, can be tax-free if it remains abroad. After the initial 4 years, however, all income and gains, regardless of where they are earned, would be subject to UK taxation. Abolition of the remittance basis. What this means: one of the most significant changes is the removal of the remittance basis, which allowed non-doms to only pay UK tax on foreign income or gains if those funds were transferred, or remitted, into the UK. This system has long been beneficial for wealthy individuals with substantial foreign investments, as it meant they could reside in the UK while paying minimal UK tax on their offshore wealth. Under the new residence-based system, foreign income and gains will be taxed based on residency status, not on remittance. This change aims to close a perceived loophole that allowed some UK residents to minimize their tax burden by keeping income offshore. By taxing worldwide income, the government expects to generate significant additional tax revenue and create a fairer tax environment. Case study: impact on long-term non-doms. Take, for example, a long-term UK resident who has benefited from the remittance basis for years. They may now face UK tax on all foreign income and gains starting in 2025, even if these funds are not brought into the UK. This individual might need to reassess their financial strategy, potentially restructuring assets or consulting with tax experts to understand the full implications. Changes for non-dom trusts. The end of preferential treatment. The new tax rules also impact settle or interested trusts, commonly used by non-doms to manage foreign wealth. Until now, non-doms could set up overseas trusts that protected foreign income and gains from UK taxation. Starting in 2025, these protections will end for non-domiciled and deemed domiciled individuals who do not qualify under the FIG regime. Trusts established to shelter foreign income and gains will no longer offer a way to avoid UK tax, impacting estate planning and wealth management strategies. Trust implications. An example scenario: imagine a UK resident who set up a foreign trust to manage assets in the US. Under current rules, income and gains within the trust are protected from UK tax as long as they are not remitted to the UK. With the new rules, any income or gains arising in the trust may now be subject to UK tax, prompting a need to review trust structures, consider potential distributions, or possibly dissolve the trust before the new regime takes effect. Summary: who will be affected most? This shift impacts both new and existing non-doms, particularly those with substantial offshore income and wealth. Wealthy international investors, entrepreneurs, and long-term residents will see the greatest impact as they lose the ability to shield foreign income from UK taxes. The changes reflect the government's focus on aligning the UK's tax policy with international standards, and for affected individuals, preparation will be essential to manage the upcoming tax obligations effectively. Capital gains tax. A new horizon for non-doms. The new tax reforms bring significant updates to capital gains tax, CGT, for non-domiciled individuals, especially those who have relied on the remittance basis to avoid tax on foreign assets. As of 2025, non-doms who qualify as UK residents will be subject to CGT on all global gains, marking a sharp departure from previous rules where they could keep offshore gains tax-free if not remitted to the UK. This change is expected to affect anyone with substantial foreign investments, such as property, shares, or other assets that accrue capital gains. Rebasing of foreign assets. A transitional relief. One of the transitional reliefs being introduced to ease this shift is the option to rebase certain foreign assets for CGT purposes. Rebasing allows affected individuals to adjust the value of their foreign assets to their market value as of a specific date before the new rules take effect. This means that, upon disposal, CGT will only apply to the gains accumulated after the rebasing date, reducing potential tax liabilities on long-held assets. The rebasing option is available to those who currently qualify under the remittance basis but will lose this benefit in 2025. Although the exact date for rebasing is yet to be finalized, it is anticipated that it will apply to assets held before April 2025. By setting a new starting value for assets, rebasing offers some protection against heavy CGT charges on gains accrued over many years. How rebasing impacts a long-term non-dom. Consider a non-dom who has owned a foreign property since 2000, and that property's value has risen significantly. With rebasing, they can adjust the property's value to its market worth in 2025, meaning any gains before that date would not be taxable if the property is later sold. However, if the property's value increases after 2025, the CGT will apply to those new gains, helping to mitigate the impact of the new CGT rules. Standard CGT rules and transitional provisions. Under the upcoming system, standard CGT rates will apply to non-doms based on their overall income and gains. Currently, these rates stand at 10% for basic rate taxpayers and 20% for higher rate taxpayers, with residential property gains taxed at 18% and 28%, respectively. Non-doms will lose the annual exempt amount for capital gains if they opt for the FIG regime, similar to the rules under the current remittance basis. Additionally, transitional provisions allow non-doms to rebase assets they hold outside the UK, reducing CGT exposure upon future sales. This is particularly beneficial for those with long-standing assets that have appreciated significantly in value, providing a buffer against the full CGT impact upon disposal. Key takeaways on CGT for non-doms with foreign investments. These changes necessitate a close examination of asset portfolios and potential disposals before the new rules kick in. Consulting with a tax expert on whether to utilize the rebasing option and understanding how CGT will apply under the FIG regime are crucial steps in preparing for 2025. Current inheritance tax rules for non-doms. Inheritance tax, IHT, has traditionally offered substantial benefits to non-doms in the UK. Under the current system, IHT is based on domicile, allowing non-domiciled individuals to keep their foreign assets largely exempt from UK IHT. As long as their permanent home remains outside the UK, non-doms are only liable for IHT on assets located within the UK, while their offshore wealth can be safeguarded. For high net worth individuals, this structure has been a strategic advantage in estate planning, allowing them to minimize tax exposure on overseas assets for heirs. Introducing the residence-based IHT model from April 2025, the UK will switch to a residence-based model for IHT, aiming to close loopholes that have allowed some long-term residents to protect foreign assets from UK taxes. Under this new approach, an individual's IHT exposure will be based on their residency status rather than domicile. Under the proposed rules, individuals who have been UK residents for 10 consecutive years will be subject to IHT on worldwide assets, even if they do not consider the UK their permanent home. Once a person qualifies as a resident for IHT purposes, their foreign assets will remain within the UK tax scope for an additional 10 years after they leave the UK. This shift aligns the UK's approach more closely with global standards and is expected to impact estate planning for individuals with significant assets abroad. How the residence-based IHT model impacts long-term non-doms. Consider a high net worth individual who has lived in the UK for over a decade but retains property and investments in their home country. Under the new rules, if they pass away after being a resident for 10 years, their foreign assets could be subject to UK IHT, regardless of whether they plan to permanently reside in the UK or have only temporarily lived there. This adjustment underscores the importance of planning, as some non-doms may face unexpected tax liabilities on their overseas holdings. Ending the use of excluded property trusts. Excluded property trusts have been a popular tool for non-doms to shield foreign assets from UK IHT. These trusts allow non-doms to transfer foreign assets into a trust structure, keeping them beyond the reach of UK IHT as long as they remain outside the UK. However, starting in 2025, the use of excluded property trusts will be significantly curtailed for UK residents. Foreign assets within these trusts will become subject to UK IHT once the settlor becomes a resident for 10 years or more, fundamentally altering the way these structures are utilized. Trust implications under the new rules: imagine a non-dom who established an excluded property trust to hold international real estate. Previously, these assets would have been shielded from UK IHT indefinitely. However, with the new residence-based model, these assets may now fall under UK IHT if the individual meets the 10-year residency requirement. This could lead to unexpected tax liabilities for the individual's heirs and may prompt them to reconsider or restructure their trust arrangements. Preparing for the new IHT rules for non-doms with significant foreign assets, the residence-based IHT model represents a major change. It is crucial for individuals to review their estate planning strategies, especially those relying on trusts to protect overseas wealth. Early planning, understanding the nuances of the 10-year residency requirement, and consulting with tax advisors will be essential steps in adapting to the new IHT landscape and minimizing exposure. What is the Temporary Repatriation Facility, TRF? As part of the 2025 reforms, the UK government is introducing a Temporary Repatriation Facility, TRF, for non-doms who have previously relied on the remittance basis to avoid UK taxes on foreign income and gains. The TRF is a limited-time opportunity that allows individuals to bring foreign income and gains earned before April 2025 into the UK at a reduced tax rate. This facility is intended to provide a transition period for those who will lose access to the remittance basis, helping them manage their finances under the new system. Eligibility and benefits of the TRF: to qualify for the TRF, individuals must have claimed the remittance basis in prior years, meaning they have kept certain foreign income and gains outside the UK tax system. Through the TRF, these individuals can remit foreign funds at a lower tax rate for a specified period after April 2025. While the exact rate and time frame for the TRF are yet to be finalized, the goal is to make this facility financially appealing for non-doms, encouraging them to repatriate funds into the UK under favorable terms. How non-doms can use the TRF? Consider a non-dom who accumulated substantial foreign investment gains over the past decade, but kept these funds offshore to avoid UK taxes under the remittance basis. Under the TRF, they could transfer these gains into the UK within the limited period, paying a reduced tax rate compared to the standard rate applicable after 2025. This could offer a strategic opportunity to bring in overseas funds, especially if they plan to settle in the UK long-term and want to access these funds domestically. Planning considerations for non-doms: for individuals with offshore income, the TRF presents a unique tax-saving opportunity. However, deciding whether to use the facility requires careful financial planning. Non-doms should evaluate the potential tax savings, consider their future UK residency plans, and consult with tax professionals to determine the best approach for utilizing the TRF within the context of the new rules. This transitional tool offers a short-term window for non-doms to reorganize their finances before the full effect of the new residence-based tax regime takes hold. Current benefits of Overseas Workday Relief, OWR, Overseas Workday Relief, OWR, has been an essential benefit for internationally mobile employees who work across multiple countries. Under the current system, OWR allows non-domiciled individuals to avoid UK taxes on income earned for work done overseas, provided they meet specific criteria, such as being non-resident in the UK for the 3 years prior to arrival. This tax relief is particularly valuable for high-earning executives and employees on international assignments, as it can significantly reduce their UK tax liability on income from non-UK workdays. Changes to OWR eligibility in 2025: with the new 2025 tax reforms, OWR will remain available but with updated eligibility requirements. Starting in April 2025, individuals must have been non-UK residents for at least 10 consecutive years before their arrival to qualify for OWR. This change introduces a more stringent residency requirement, narrowing the pool of those eligible for OWR and targeting only those who have been away from the UK for an extended period. Employees who previously qualified for OWR but have been absent from the UK for fewer than 10 years will no longer be eligible, which may impact international mobility for some businesses and increase tax costs for affected employees. Impact on an international executive: consider an executive who has been living abroad for 5 years and moves to the UK in 2025 with a job that requires significant international travel. Under the new rules, they would not qualify for OWR due to the 10-year non-residency requirement. As a result, they would be taxed on all their income, including earnings from non-UK workdays, creating a higher tax burden than they might have anticipated. Implications and planning for employers and employees. The updated OWR eligibility highlights the importance of careful residency planning for employees on international assignments. Employers may need to adjust compensation packages for globally mobile employees to account for the loss of OWR benefits. For individuals, understanding these changes and their impact on net income is critical. Consulting with tax experts can help identify alternative tax strategies to mitigate the additional tax costs that may arise from the new OWR requirements. Economic concerns. Will the new rules deter investment? The 2025 tax changes for non-DOMs have sparked debate over the potential impact on the UK economy. Supporters argue that the new tax structure creates a fairer system, aligning the UK with global standards. However, critics warn that the reforms may deter wealthy foreign nationals and investors who have traditionally viewed the UK as a tax-friendly destination. By imposing taxes on worldwide income and gains, the UK could risk losing high-net-worth individuals who bring substantial investment, job creation, and spending into the economy. Several economists point out that non-DOMs contribute billions in direct spending, property investments, and donations to cultural and educational institutions. There is concern that the new rules may drive some of these individuals to more tax-advantageous countries, potentially impacting sectors that benefit from their investments. With countries like Portugal, Italy, and Malta offering attractive tax regimes for foreign residents, the UK may face increased competition for these global investors. Potential loopholes. Are there still ways to minimize tax? Despite the government's aim to close tax loopholes, some experts argue that opportunities for tax minimization may still exist, especially through offshore structures and trusts. The new rules on excluded property trusts, for example, still allow certain types of planning if individuals are strategic about timing and asset location. Additionally, the Temporary Repatriation Facility, TRF, offers a limited window where non-DOMs can bring funds into the UK at a reduced tax rate, allowing for potential tax planning before the new regime fully takes effect. Critics argue that these remaining avenues may still favor wealthy individuals who can afford sophisticated tax planning advice, meaning the rules might not fully achieve the intended level of fairness across all UK residents. International comparisons. How does the UK measure up? Comparing the UK's new regime to international standards reveals a mixed picture. The United States, for instance, taxes citizens on worldwide income regardless of where they live, which is stricter than the UK's current approach. On the other hand, many European countries provide favourable tax regimes for foreign residents, such as Portugal's non-habitual resident programme, which offers substantial tax breaks for a decade. While the UK's 2025 changes align it more closely with global standards, there is still debate on whether this approach will enhance or undermine its competitiveness in attracting top global talent and investment. Public opinion and political pressure. The new tax policy reflects ongoing political pressure to address income inequality and close loopholes perceived as favouring the wealthy. This shift is viewed by some as a move towards social equity, ensuring that those who benefit from UK residency contribute fairly to public finances. However, the debate remains polarized, with advocates and critics both highlighting the complex balance between economic competitiveness and tax fairness. Planning for the transition. Key financial strategies as the new 2025 tax rules approach. Non-domiciled individuals should start preparing by evaluating their assets, residency plans, and potential liabilities. The shift from the remittance basis to a residence-based tax system means that those with significant foreign income or assets will need to adopt new financial strategies to minimize tax exposure. One of the first steps is to consider rebasing foreign assets to their 2025 market value, which can reduce future capital gains tax obligations. Early planning is essential for long-term residents who will soon be subject to taxes on worldwide income and gains. Another critical aspect is to evaluate the use of trusts and other structures. Non-DOMs who have relied on excluded property trusts may need to assess alternative options or even dissolve these trusts, as they will no longer provide the tax shelter they once did. Working with tax experts can help individuals make informed decisions about their wealth management strategies, especially with complex foreign assets involved. Deciding whether to use the Temporary Repatriation Facility, TRF, for non-DOMs with foreign income accumulated under the remittance basis, the TRF presents a short-term opportunity to bring funds into the UK at a reduced tax rate. This facility is ideal for those who anticipate staying in the UK long-term and wish to repatriate foreign income before the full tax implications of the new regime apply. Consulting with financial advisors to evaluate the benefits of the TRF, including potential tax savings and time limits, can help non-DOMs make the most of this limited time offer. Consulting professionals, the value of expert guidance given the complex nature of the 2025 reforms, consulting with tax and financial advisors is crucial. Tax experts can provide tailored advice, helping non-DOMs navigate CGT rebasing, trust restructuring, and other wealth management options. For those unfamiliar with the UK's evolving tax landscape, professional guidance can clarify the most effective strategies for compliance and long-term financial stability. Financial checklist, actionable steps to simplify the transition. Here's a quick checklist for non-DOMs. 1. Rebase foreign assets, set asset values to 2025 levels to minimize future CGT. 2. Evaluate trusts, review and potentially restructure or dissolve excluded property trusts. 3. Consider the TRF, decide if the TRF can benefit your foreign income and gains. 4. Seek expert advice, consult with tax professionals on personalized strategies. 5. Update financial plans, ensure your wealth management aligns with the upcoming tax rules. By taking proactive steps now, non-domiciled individuals can reduce their tax burden and prepare for a smoother transition under the new regime. To recap, the 2025 tax reforms for non-domiciled individuals bring a monumental shift in the UK's approach to foreign income, gains, and inheritance. These changes, aimed at creating a fairer and more transparent tax system, mark the end of the remittance basis that has allowed non-DOMs to shield offshore earnings from UK taxes. From now on, the new residence-based tax system will require individuals who reside in the UK to pay taxes on global income and gains, reshaping the financial strategies of wealthy international residents, investors, and long-term expatriates. Key changes include the 4-year exemption period for new residents, the abolition of remittance-basis tax treatment, updated inheritance tax rules based on residence, and new restrictions on trusts. These shifts signal the government's intention to close tax advantages that were previously accessible to wealthy individuals residing in the UK, bringing the UK in line with more globally standard practices in countries like the United States. The importance of planning and seeking professional advice as these changes come into effect. Early planning and professional advice are crucial for non-DOMs to adjust smoothly. By understanding and leveraging the available transitional provisions, such as CGT rebasing and the Temporary Repatriation Facility, TRF, individuals can mitigate some of the impact. Engaging with tax and financial advisors can help non-DOMs evaluate options for structuring assets, planning for inheritance taxes, and aligning investments with the new tax landscape. The 2025 tax reforms will undoubtedly change the appeal of the UK for certain non-domiciled individuals, particularly those who have relied on the remittance basis to shield foreign income. However, these changes may ultimately encourage transparency and equality within the UK's tax system, addressing long-standing disparities. For those navigating these changes, staying informed is essential. Subscribe to this channel for more updates on tax laws, financial insights, and practical guidance. Make sure to check out our related videos on UK taxation and wealth management strategies to stay ahead of these changes. By understanding the details of the 2025 reforms, non-domiciled individuals can be better prepared to make informed financial decisions in this evolving tax landscape.